Okay, we're just going to go ahead and get started. So, welcome everybody to the October Elevate event. My name is Adam Koch, a business transition consultant and founder at Elevate. I'm also the president, portfolio manager, and senior financial advisor at Libertas Wealth Management Group in Columbus, Ohio. And I'm hosting alongside financial advisor, certified retirement plan counselor, and certified financial planner in Kim Warwick. So, let's get started with a little bit of housekeeping as always. Elevate started with three statistics in mind, and they go like this. 80% of business owners' net worth is tied up in their business. And if you're a business owner paying attention to this right now, which I'm sure you are, this probably sounds familiar to you. So 80% of businesses also never ever sell. They dissolve in the end, leaving the owner or owners with absolutely nothing to show for their life's work, let alone their families. Lastly, of the 20% of companies that do sell, 75% of those 20% exit their business for less than fair market value. And this is just, it's a tragedy. So when I say Elevate started with these three statistics, it's crucial to understand our mission here, that all the education we share, as well as the consultation we offer through our professional partners, I always say that we need to get the phrase exit planning out of our vocabulary, because it doesn't matter if you're planning to sell your company in 3 years or 13 years. Business transition planning is something that every growing and or mature business needs to get unstuck, take their company from good to great, as Jim Collins says, and whether you're selling soon or not, to create a sellable enterprise today. So for more information on business transition consulting, exit planning, retirement planning, executive benefit plans, and investment management for business owners, head over to elevateandexit.com. Be sure to not miss any of our future events, podcasts, and live events by signing up for our invitation list and our newsletter, which you can also find at elevateandexit.com. You should also subscribe to our YouTube page, where all of these webinar replays as well as podcasts are published. And all of our educational materials are aimed directly at growing your business, increasing profits, increasing efficiency, reducing the amount of time required of the owner within the business, de-risking, all while growing the enterprise value of your company, along with your net worth, so that you can make work optional and lead a stress-free lifestyle. All guests and attendees, as always, will remain intentionally confidential throughout the entire presentation and throughout the Q&A session that'll follow at the end. So if you're listening and or watching, please enter any questions you have into the chat or Q&A, whichever you're comfortable with. And what we'll do is we'll compile them anonymously at the end, after which all questions will be answered at the conclusion of the presentation. And if for any reason we happen to run out of time today, and we will be stopping right at 1 o'clock, all questions will be answered and delivered directly to your inboxes that you use with the email you entered when you RSVP'd. Okay, enough of the housekeeping. Today, I'm super excited to introduce our featured speaker, Bob St. Germain at Corporate Finance Associates Worldwide. Bob has spoken before on a podcast. We're going to be doing another one this month. But I've always known, well, I've known Bob for about 18 years, and I've always known that he's an absolute top-notch expert in his field. What I didn't know when he was on our podcast last year is how unbelievably he is at education. So when it comes to presenting this material, making it easy to understand, this is going to be a great presentation. So he's the managing director and principal for Corporate Finance Associates in Columbus, Ohio. He has so much leadership experience stemming from his military career, executive level positions in small to Fortune 500 corporations, and from serving as principal at another private investment bank. His corporate M&A experience included work on acquisitions, divestitures, and joint ventures, serving on the JV board, participating on the sell-side management teams in separate $2.2 billion with a B and $470 million mergers, as well as dealing with many challenges that you face post-close, whether it be cultural and integration issues associated with those types of events. So again, be sure to prepare your questions. Again, it'll be anonymous Q&A at the end, but let's go ahead and dive in. So Bob, take it away.
Very good. Thank you, Adam, for the introduction, and thank you for our participants who signed in to see a presentation. Plan now to sell for more, and getting exit out of the vocabulary, I think, was how Adam had presented this or teed it up. We're going to use exit in our vocabulary, but I really wanted to take a different tack. There are a lot of great presentations online in written form and otherwise about how to exit a business, how to prepare for that. So what I thought I'd do to differentiate this presentation from all of those was to take it from the buyer's perspective. The thought there is that if you understand how buyers think, operate, go through the process, you'll be better prepared if you're a business seller to really bring your business to market. And so with that in mind, let's get started. I typically start with a scold, but it looks like Adam already took us there. Probably the takeaway from this slide, as well as his points about owners' wealth being typically tied up mostly in their businesses. But the other thing is the minority of business owners have an exit plan. You juxtapose those two stats together, and it paints a pretty sad picture, actually, given the importance of a liquidity event in the business owner's life. So the takeaway from this slide is don't be that guy or gal. You need to have an exit plan. And what we're going to go through next is going to be hopefully helpful in helping you go down that path. So having been properly scolded, let's move on. Okay, we're going to get into the exit. And what I want to talk about here, high level, what buyers are looking for, how they think, how they value, so that again, from the seller's perspective, you have more insight into the other side of the table. So let's get started. There are essentially 7 different types of buyers and 7 different ways of exiting a business. And those are arguably arrayed from the least rewarding at the top to the most rewarding at the bottom. Just to give you some highlights, you can certainly sell the asset. You can liquidate for pennies on the dollar. If you're in a partnership arrangement, you're going to have typically, you should have a buy-sell agreement. And buy-sell agreements, if they're properly crafted, they're going to be very conservative in the valuations that they allow partners to walk away with. They're not designed to encourage partners to leave their partners behind and get a big bonus check, if you will, upon departure. So typically those are conservatively crafted. Payouts are over time to not burden the remaining partners. You can certainly sell to children, family, or management, but typically they don't have the financial wherewithal to completely buy out the owner. And so there's going to be a note having to be carried by the owner, which may be fine, but again, it's a tripwire, if you will, in that kind of an exit. Can sell to employees through an ESOP plan, but because those are tax advantaged, the valuations are typically very conservative relative to going out to market. And because of that, oftentimes the business owner is going to have to carry a note there also. You can certainly sell to the public, but it's very few private companies are really eligible for that. We're talking here about companies that are fast growing, typically some cool technology, really creative differentiation out in the marketplace. Few companies have those characteristics to step up to a public or an initial public offering or sell to a special purpose acquisition company, which leaves us down at the bottom selling to a third party with an M&A transaction, a leveraged buyout, or a recap, where a recapitalization is selling part of the company. And we'll describe that or discuss that more as we go along. So for the purposes of time, we're going to stick with that last bullet, selling to a third party, and talk about how the buyers think, act, et cetera, in that regard. So let's get moving there. The algorithm you see at top are how businesses tend to be thought of in terms of valuations. Just at EBITDA times a multiple, where EBITDA, you can see in the little photo to the right, earnings before interest, taxes, depreciation, and amortization, as adjusted. And you'll see that the adjustments are around non-operating expenses or revenues, non-recurring expenses or revenues, extraordinary comp. When we talk about non-operating expenses, an example of that would be the fleet of personal cars that a business owner puts through their P&L. Those would be added back in terms of expenses because they're not operational necessities. Non-operating revenue might be an example of that, would be the Paycheck Protection Plan. Revenues that hit during COVID, not an operating revenue. Basically, those would be subtracted from EBITDA for that year. A non-recurring expense might be an example would be The deductible for an insurance expense. You had a fire in your warehouse and there was a large deductible. Well, that's not a recurring, typical, normal part of your business. That would be added back. Non-recurring revenue might be the lot next door to your facility that you sold. It was on the books of the operating entity. Again, it has nothing to do with the normal operation of the business. It's non-recurring. It'll never happen again. Extraordinary compensation, what we're trying to find there is not only what is the owner's comp relative to the market at, above, or below, but many businesses will operate out of a physical facility owned by the operating company ownership, but held in an LLC and then leased back to the operating entity. And so the question there is, how is that lease? Is it at market, above, or below market? After all those adjustments are made, and that's more the scientific part of the algorithm, the art comes with the multiple. And the multiple is basically applied by the buyer. That's the buyer thinking through what they know about the target company. What is the likelihood that they're going to be able to replicate or exceed the kinds of EBITDA, adjusted EBITDA, or cash flows that the current ownership team is enjoying? And basically, that algorithm begins to set up how they think in terms of evaluation. They're also going to be running very complicated, complex, if you will, pro forma financial models, which will include this kind of information. But this is where they get started and how they get started. Now, let's see, how does it play out in the marketplace in terms of that thought process? Again, the buyers are looking to assess risk. And the attributes, these are the positive attributes that they're going to be looking for and validating via due diligence, which we'll talk about later. The more of these attributes that are in place, the less risk it would appear to the buyer. And there's an inverse relationship between the multiple and the risk. The higher the risk, the lower the multiple. The lower the risk, the higher the multiple. Just a couple of examples. Imagine company A that has backlog of a year and company B has backlog of about a week. Well, company A looks stronger, all other things being equal, and less risky, and hence would warrant a higher valuation than company B. Diversified customer base. Imagine a company that has 1,000 customers versus a company that's got 5. That customer, the company A with 1,000 customers is going to be perceived likely, everything else being equal, lower risk, hence the higher multiple. And you can go down this list and basically understand where, from a buyer's perspective, again, the more these protections that are in place, the more confident they are in the buy, the less risk they perceive, the higher the multiple, the higher the valuation. And in the bottom, revenue and cost synergies. Every buyer is targeting companies with the view, assuming they already own a company, to, in consolidated format, to enjoy revenue and cost synergies that come out of the combination. And we'll show and talk about that a little bit later. Show you what's happening in the marketplace. Another way multiples and risks are assessed. If you look down the extreme left column, bolded, millions of dollars in TEV, total enterprise value. Those are price ranges that deals were done. Now I'll draw your attention to the second to the right column under total. Notice how the EBITDA multiples grow from 5.9 to 10.0 as the size of the transaction grows. Another indicator about how buyers think and how they assess risk. A $500 million company, $500 million enterprise valued company compared to a $10 million company, much less risk, all other things being equal. There's going to be more scale there, more market share there, more competent management typically. There's going to be more sophisticated systems, policies, procedures. Cost of capital is typically going to be less. Again, in contrast with a smaller company. And so you can see among the other things that drive multiples, it's the size of the company from the buyer's perspective. There's another thing buyers are looking at and they're willing to pay a premium for. If there's above average financial performance in the target, they are willing to pay a premium. And you can see that in the fourth column down or fourth row down, bolded. And what we mean by above average financial performance, you'll see in the note. If there's trailing 12-month EBITDA margins or revenue growth, both above 10%, or one above 12, the other above 8, that's deemed to be above average. And buyers are willing, and if they go through a competitive process, have no choice. They're going to pay a premium to acquire that target. Another thing that is in the buyer's mind is what's the industry that the target is engaged in. Again, look at the left-hand column and you'll see the various high-level industries. Look at the second to the right total and go down there. And what you'll see, for example, manufacturing at a 6.4 multiple on average, technology at 8.6. So another thing that's going into the buyer's calculus is what is the industry and what are the dynamics and what are the risks associated with a given industry. Manufacturing, nothing wrong with it, but typically high capex every year, worldwide competition, et cetera, in contrast to technology companies, which tend to be more nimble, more applications for what they do, and the like. And so you can see that part of what they're baking into their risk assessment is, again, the industry and the dynamics associated therewith. Another thing that drives the multiple is the target being represented by an investment banker or an M&A advisor or not. There's an interesting study that was done. You can find this on the internet. And I'll just drop to the bottom line, the bottom bullet down there that's bolded. They basically took a look at 3,000 private transactions, half of which were represented by M&A advisors. The other half were not. The other half essentially just dealt one-on-one with a given buyer, went through the transaction on their own. And what the study demonstrated is that sellers who, excuse me, used an advisor typically earned a premium of 25% compared to those that did not. This is one reason why buyers will often try to go directly at sellers. Private equity groups, strategics, they'll actually call corner people at trade shows, et cetera, and try to engage directly to ensure that the seller is not being processed or advised to help them save the 25 up to 25%. The unfortunate result, however, is that the seller is losing that premium. So those are some of the dynamics that are going in terms of the buyer's mind and how they value businesses. Took a drink of water. Sorry about that. So let's talk now about what's the kind of planning that buyers will go through. Buyers come in two types. Well, business owners come in two types. There are those that really just kind of get to that $1 million, $5 million, $10 million revenue plateau, and then they basic financials, you'll see the revenues kind of sawtooth around an average of those kind of numbers. There are business owners who have an opposite view, and that is the business is an investment or an appreciating asset. And those are the ones that are actively out buying, looking to help grow their enterprise to rise value. Every company can grow either internally or externally. Internally, we all know that taking existing products and services or new product and services out to existing customers or new customers and markets. Company typically does that if they are in growth mode and they're not into more that lifestyle business mode. They will also, however, typically have a component we call non-organic or an external component. And you can see the kinds of ways that companies will grow. Divesting all or part of the company may be counterintuitive, but often part of the growth strategy is to divest and repurpose capital that comes out of a divestiture. You can see the other elements that typically lend themselves to a non-organic growth plan. And what we're going to focus on is that last bullet, another company. And why do they acquire versus trying to start up something? And I'm using startups here, not just from an entrepreneurial perspective. Entrepreneurs have two choices if they want to leave corporate life. They graduate from their school and they want to go start a company. They really basically two choices: acquire one if they've got the wherewithal to do that, or start up a company. Well, the dramatic difference in end statistics is it pretty drives people one way or another. Existing companies tend to be around for 5 years post-close. Startups tend to fail within the first 5 years. And buyers of companies, even if they have platforms that they're operating from, think the same way. Consider, for example, a company, I'll make it up, in Boston looking to plant their flag here in Columbus. We're noted to be one of the fastest growing MSAs in the country, so why not? So company A in Boston says we're going to plant a flag and in Columbus and start a division out there, or et cetera. So what are they faced with? Basically, it's a startup. They've got to acquire a facility, depending on what they do. They've got to bring people out there or hire here that up a load of inventory, assuming that business requires it. They've got to do the marketing. They got to spend all the upfront monies to wedge into a new marketplace where there are incumbents who are very successful already. That's going to take a lot of cash. They're going to go negative cash flow for several years before they even break even, if they ever do, and assume all the risk associated therewith. In contrast, they could buy a company in the marketplace and they're starting from scratch. Look at what comes with an acquisition in contrast to starting that new division, if you will, here in Columbus, using my scenario. Everything's in place. And they have the opportunity through due diligence to validate that everything's in place and it's of a quality that warrants their buying that company. This is how buyers think. They're looking to basically get into situations as efficiently and effectively as possible. And again, I'm going to use that bottom bullet. They're looking for the revenue and cost synergies to enhance the value that comes out of an acquisition. And that's an important ingredient. Let's talk a little bit about that. What do we mean by revenues and via the synergies that come from buying a company? Again, if there's an established company, that's what they've targeted. That's what they're looking to buy. Due diligence say it's a good deal. Look at the possible things that come with it. May not have all of these, but if it even has a subset, this is stuff that comes with an acquisition that can enhance the revenues of the acquiring company, the buyer. All powerful, all can, again, lend itself to increasing the revenues post-close. Among the things that buyers are looking for and why they choose to buy, as opposed to starting up in a new location, as my scenario suggested. There's also the cost side of the equation. Consider all of the consolidation possibilities that can come with, and we've got some listed here. Obviously, I'm not going to go through those, but if you can consolidate and reduce the cost of the consolidated enterprises, you've got another powerful part of the story that comes with making that acquisition. So again, this is also what buyers are looking for when they're out looking to acquire. And just a simple graphic to show the buyer that stays with an organic, or rather the company owner that stays with an organic growth plan versus those that will certainly grow organically, but have some step functions in their growth plan and by a non-organic growth by acquiring other companies. Typically, over time, they're going to basically harvest all this area between the lines. Just a simple way of showing that. And I think I skipped a slide. This is the one I wanted to conclude with. Imagine the power that comes from aggregating the synergies from both increasing the revenues, decreasing the consolidated costs. What does that do to the EBITDA and importantly to the enterprise value of the consolidated entity? and reflect back on those charts that I showed you. Not only is the larger company generating more EBITDAs if they're properly run, obviously, but the larger company is also being more highly valued because the multiple is also elevated for those higher revenues and a higher EBITDA type company. So you get a compounding effect. And that's what the buyers are ultimately looking for. Finding the target that's going to allow them to achieve what's on this page. And we've already gone through this. And at the end of the day, when they're ready to exit, they now have a much larger, more valuable enterprise by going through what we just described. So, whoop. So what is the process that they're going through, and what is their thinking as they're going through the process, which is what I want to take you through now. Many times, again, presentations will talk about our side or the sell side, but I want to talk about, in each of these steps, what is the buyer faced with, what do they look for, et cetera, and how do they handle it. The first thing that a buyer is expecting is that the seller is going to have a deal team in place. Not every seller does, and that is to their disadvantage. The team is going to be comprised of at least the components you see here. If the buyer sees anything less or quality of the each of the players here that's not up to the task, they will take full advantage of it. They would prefer not to have an investment banker associated with the process. They prefer not to be in a process if they could possibly get away with it, for the reasons that we've showed you earlier. From their perspective, they're going to save maybe up to 25% as opposed to participating in a process and competing with others like themselves. The attorney, it's got to be an M&A attorney, a corporate attorney. This is a very esoteric, ever-changing part of the law, and sellers need to be represented by good counsel. Same with an accountant. If the accountant that does your 1040s, that's one thing, but if that accountant doesn't have M&A experience and can help guide the seller through the process, or the buyer is going to take full advantage of the lack of either lack of attorney or a weak attorney, the lack of an accountant or a weak accountant. And certainly a wealth advisor, somebody like Adam. There's a lot of good work that a wealth advisor can do to help both in pre-close planning and as well as post-close implementation. So again, the tail of the tape here, the takeaway is the seller needs to have a strong deal team. The buyer's hoping he or she doesn't, because they want to take advantage of the seller as much as they can. And we'll talk about how much can that be pushed or not pushed. But anyway, I hopefully get the point there. What it look like? It's typically 9 steps. And this is something that, again, some buyers will try to do on their own. But an investment banker process is basically going to look like this. Not going to go through each of the steps, just kind of go from the 40,000 foot level. There's a whole bunch of information gathering at the front end. There's the creation of various marketing documents coming out of that. There is the research to identify and screen potential synergistic buyers. And again, if it's in the hands of an investment banker, synergy always plays a role. We're not just looking for buyers, we're looking for potentially synergistic buyers to get that kicker in terms of the deal heat and the eventual valuation. There are important steps or gates through which a process will take a buyer. Again, they prefer not to go through it, but the indication of interest or call for IOIs, call for indication of interest, is the first step where buyers who have expressed interest in the target are being asked to come up with some preliminary offers. And it gives the seller an opportunity to negotiate, or their parties on their behalf to negotiate and down select to the credible parties that come out of that level of or that portion of the process. The next gate is basically the call for letters of intent. And what's going to come out of that is a further down selection to an exclusive party. One of the things that comes out of a process that, again, buyers would prefer not to be going through because they're going to have to compete to gain the status of being an exclusive party. What that basically says is that for some agreed upon period of time, very typically 90 to 120 days, that buyer is going to have exclusive rights to information from the seller, and the seller is going to be essentially off the market, not able to talk to anybody else or share any information with anybody else. It is not an unfair ask by the buyer because the buyer at this point in time is going to be doing some due diligence, very deep and broad due diligence. We'll talk about that in a moment. And that's a very expensive process. And for that privilege, they're demanding and they have the right to demand exclusivity, at least for that period of time. And then hopefully, the due diligence turns out well. The company turns out to be what they thought it was. And the parties can negotiate a definitive purchase agreement or DPA, and then we go through a close. We've been talking about buyers. Let's define them a little more carefully or succinctly here. Basically, three types, and it depends on the size of the target, obviously. But there are strategic, financial, and individual buyers, and is how we describe them in our world. A strategic buyer is essentially an operating company. It could be very much like the seller, could be in the seller's space, maybe a competitor, a larger player in the space looking to grow by acquiring them. It could be a company in an adjacent space looking to grow their company by getting into the adjacency and out of exclusively, at least, the space that they're currently in. A typical outcome, a strategic buyer typically wants to buy 100% of the target company. And so it becomes what is the seller's perceived goal or preferred goal. That's why we add the ownership under each of these categories. If the seller is interested in only a partial sale, then maybe the strategic buyer is not the party to be talking to. The financial buyers, on the other hand, as you'll note before I describe them, will typically be interested in buying a minority, a majority, or 100%. Some are focused and are exclusively will only do minority deals. Some will only do majority or 100% deals. And those are the key differentiator of financial buyers from the operating companies, at least from an ownership perspective post-close. Now, private equity groups. These are firms that basically pull together institutional capital, typically into a 10-year fund. The first half of the fund they invest, the second half of the fund they divest. Between the two events, they hopefully improve the companies so that between the acquisition and the divestiture, they make a profit for themselves and their limited partners. And that's what makes private equity groups go. They absolutely live and die by buying companies. That is their sole reason for existence. Family offices are similar. However, family office is essentially an investment vehicle created by a family that's already extracted their wealth, typically through a liquidity event. Basically sold a large company of their own, post-close, working with guys like Adam, basically set up a family office to at least invest a portion of their portfolio into other privately held companies, trying to benefit from exits eventually, much like they did on their own. These typically are long hold players. So in contrast to private equity that's going to flip within 3 to 5+ years, family offices, they'll hold for decades, depending on how they strategize going forward in the family office charter. Search funds are a different animal, although we deem them to be financial in scope. Search funds are a creature of Stanford University. They were founded, or the concept was initiated about in 1994, if I remember correctly. And essentially, what professors, particularly in the business school out there, were beginning to see and anticipate was very bright students, high energy, good leadership skills in their classrooms that would make good bets as company CEOs, partial owners, post graduation. And so search funds were set up as a concept whereby the professors would pool their fund, in effect becoming limited partners, if you will, in a fund, paying a stipend to the graduate that they have a lot of confidence in to work for a year or two to find an enterprise that they would invest in, set him or her up in to become CEO and run the enterprise, and hopefully get them a nice return when it came time to exit. So those are the kind of financial buyers. Strategic and financial buyers, those are typically companies, or typically buyers rather, that are looking for enterprises that are typically, and there's always exceptions to the rule, but think in terms of companies generating 10 plus million dollars in revenue, a million five in EBITDA annually. If they're smaller than that, individuals begin to play a role. Now, individuals, the one thing that gets lost here is that first foray typically out into the marketplace. So they're not going to bring the ability to have kickers on their offers derived from synergies, revenue or cost synergies. They're looking to buy their first company. They may be very talented individuals coming out of corporations, corporate refugees, kind of term of art we're using there. Typically will have a certain amount of revenue. Wealth will be bankable to a point. They're on the scale. They typically want to start with minority and then buy as they mature in the company that they purchase. And basically over time, assume 100% ownership. So again, that becomes a viable buyer, typically for smaller companies. So again, when we're referring to buyers, I wanted to just put on the map what we're talking about specifically. Want to go into the due diligence. Mentioned that several times in the presentation. Not going to go through this. Rather, the intention of this slide is to emphasize a couple of things. Number one, much to the consternation of sellers, when buyers sign an LOI, they got exclusive rights to due diligence, and the due diligence part starts. Sellers are often totally unprepared for what is to come. That is one of the reasons why those who plan for an exit, work with guys like Adam in advance, have a lot of their ducks in a row so that they are prepared for the deep and broad dive that a buyer is going to make. It's often resented by sellers, but from the buyer's perspective, they're going to be spending a lot of money on this enterprise. They've got a right and they've got an obligation to their shareholders, their limited partners, themselves, if it's an individual, to know what they're buying and where the nooks and crannies are, the pluses and the minuses. It also helps them, number one, validate certainly that this is an enterprise worth buying at the price they have put into the letter of intent. But further, it allows them to begin to pre-plan how are they going to integrate this thing, this new enterprise, post-close. And it allows them to start doing, even during the due diligence process, integration planning before close actually takes place. So again, a lot of time, a lot of effort will be taken by the buyer to go through this. Again, one of the things that the sellers often don't understand is that due diligence not only is it time consuming on their part, it's time consuming on the buyer's part. Further, buyers are spending a lot of money on due diligence. They typically are using not only internal resources, maybe you could say that's a sunk cost, but very often external, external resources, which come on an hourly basis. Not unusual for due diligence process to cost in the six figures You'll notice down at the bottom, quality of earnings report, essentially a very deep dive into the accounting and the finance part of a business. Q of E reports typically generated by third parties. Those on their own will typically cost $50,000+ into the low hundreds of thousands of dollars as just one component of due diligence. So low mid six figures due diligence costs are not untypical. And again, depending on size and complexity of the target, higher up in the range, smaller ones lower in the range. So just wanted to make that point because it often comes up by sellers questioning what is this all about and why. Um, the process in terms of the deal itself. Okay, now we've teed everybody up. We understand how buyers and house think, how they generally value, what they look for, how they're risk averse, how they want to compensate for risk, at least conceptually. So how does the deal come together, and what are the issues here? And what I teed up here is a slide that basically contrasts what buyers are looking for, what sellers are looking for. And if you read from right to left or left to right, what you'll notice is a natural tension in the deal making process. I've kind of shown or tried to illustrate that with the photo here of a tug of war. It is a tug of war. When you're going through the deal, what is good for the buyer is typically bad for the seller. What's typically good for the seller is bad for the buyer. And somewhere, therefore, in the middle of the road, negotiations have got to find that midpoint where both parties are reasonably satisfied to finally pull the trigger to do the deal. Just to highlight a couple, I mean, clearly, from a buyer's perspective, they're trying to be sure that the allocation of risk in the deal is fair. They're trying to get at the lowest price. I mean, they wanted the highest ROI they can get. You see that down further in the list for their shareholders themselves or their limited partners. The one thing that they are sure of, because it gets validated in due diligence, is the historical performance. You contrast that with the seller says, geez, I've got a great company here. And if you could only do this, if I only had the time, these are the kind of things that in the future I would be able to accrue to. And I want that incremental value to be rewarded in the deal. Um, so clearly very opposite ends of the spectrum in how philosophically that issue gets handled. Seller, ideally, unless it's from a tax perspective, there are different consults that they'll get or recommendations from their tax advisors. They want all cash up front. They want no risk associated with waiting for payment in the future, where in contrast, obviously, or maybe not obviously, the buyer would prefer to put as little cash as possible. Again, it's the allocation of risk. Stock transaction the seller would want versus an asset transaction the buyer wants. Very important tax considerations here. An asset transaction is beneficial to the buyer because the assets can get rewritten up to their full market value as price gets allocated against those assets and then redepreciated to help cash flow for the buyer post-close. That hurts the seller, however, because they now are being paid for those assets. There's going to be depreciation recapture and regular tax treatment on how those assets are treated from a tax perspective. The stock transaction from the seller's perspective is great because they basically get capital gains treatment on their gain. But that hurts the buyer who just lost the asset treatment, and there are hybrid versions of deals to allow both parties to be satisfied. But again, that comes out of negotiations. And the rest, I think you can see very clearly, pretty much can be accommodated, again, with proper negotiations. Probably the last thing, private business owners typically have a lot of affection for their employees, in contrast to public companies that will shed employees very readily. And typically, sellers want to save them. Buyers don't want to be constrained. I mean, they're certainly wanting and willing to save employees, but they want to be selective about those employees that they do save. So again, that's the natural tension that comes from trying to structure a deal, and the dynamics thereof, and the need for proper negotiations and the value of an intermediary between the parties. The goal, probably I was getting at this indirectly, but let's just kind of put it up here. If it's not going to be a win-win situation, the statistic that Adam cited, and if I remember correctly, Adam, only 30% of deals get done typically. It's because somewhere along the line, the process fell short. Buyer and seller could not come together on price, on terms, on deal structure. Something came out of due diligence. Something happened to the company during the period between going to market and close. Maybe they lost a major customer. Marketplace dynamics changed. Any number of issues can arise that will prevent a deal from getting done. So often a surprise, and I'm glad, Adam brought it up initially, is that not every deal gets done. In fact, only a minority of deals get done, because if it's not going to be a win-win, unless one party or the other is willing to give up too much, ain't going to happen. So I just wanted to emphasize that point. So what does a structure of the deal look like? And again, this is where you begin to see where that allocation of risk starts finding its way into the actual deal itself. Now, what you're going to find is that the buyer is going to put a certain amount of equity into the deal, most often cash. If it's a public company, maybe they're going to offer their stock, maybe some combination of cash and stock. But that's the buyer's equity. And they're going to want to put in as little as possible, assuming that the consolidated entity can handle the debt burden that will come with the transaction. Every deal is going to be leveraged to some degree. In the private equity world, just kind of uses a rule of thumb, 40% equity in, the rest is in some form of debt financing. But again, in the further allocation of risk, not only putting debt onto the shoulders of a third party, albeit it's got to be serviced, obviously, by the buyer, they're going to ask typically for the seller to have some skin in the game post-close. In other words, the seller actually being asked to facilitate the sale by helping to underwrite the transaction with some portion of the agreed upon price in the form of a seller note. Seller note being payment of a portion of the seller price, as I said, over time, over an agreed upon period of time, at an agreed upon interest rate, and at certain agreed upon payment intervals. They're also going to want to mitigate their risk by integrating the deal structure. Earnout agreement, similar to a note in that it's payment over time, but it's payment of a certain agreed upon percentage of the agreed upon price if certain performance metrics are accomplished or achieved post-close. And those performance metrics could be hitting certain revenue targets, maybe gross profit targets, maybe EBIT targets, EBITDA targets, maybe it's customer retention targets, customer growth targets. It could be any creative thing that gives comfort to the buyer that the seller is going to work hard post-close to make those performance goals come to fruition. And if they don't, the seller will not be paid that portion of the agreement, and the buyer is off the hook. So again, you can see allocation of risk coming out of that element of the deal, if in fact it ends up in the deal structure. And not every deal has all of these. It's all a result of negotiations, but it shows you how the allocation from a buyer's perspective, they're trying to make happen to their advantage. There will typically be an employment or a consulting contract post-close, and there could be some value associated with that, obviously. If there is real estate, and unless it's a completely remote company, there's going to be real estate either in the form of a lease or a purchase, and that would be assumed by the buyer. Financial buyers will typically never purchase property or facility. They will lease, they'll assume a lease and negotiate a lease. And so that is how a deal will be structured and how typically each of the parties is trying to fight for their fair allocation of that risk. That's how it finds itself in the structure, and that comes out of negotiations. Now, cash at close is a different animal. It's related, obviously, to how the deal was structured. But what's often a surprise to sellers, unless they're properly advised by their advisory team, is that the selling price, or rather the cash at close, is not the selling price. It'd be ideal if it would, and as you saw the list of their wants, that would be what they would typically like. They will typically get from their selling price, they'll be able to retain the cash that's on their balance sheet at time of close, or a portion thereof, and that depends on a concept I don't want to get into the weeds about, but just assume that they will retain their cash. If there is that promissory note I talked about earlier, that cash will come to them over time. So that will not be readily available at time of close. That will be paid out over time. If there is that earnout agreement that we talked about on the previous slide, once again, that cash will not be available unless those performance metrics are met over time and paid over time. So between the promissory note and the earnout agreement, even if everything hits all 8 cylinders and does become payable, it's payable over time, not at close. There's a new item here that was not on the previous slide, and that's an escrow agreement. And not unusual for buyers, again, in the interest of mitigating their risk. Again, it all goes to this risk allocation. Buyers will often try to work into their deal structure an escrow agreement. Now, an escrow agreement or holdback, also known as a holdback, often 10% of the purchase price for 12 or 18 months. That is related to the representation and warranties that are in the definitive purchase agreement. The definitive purchase agreement will cause each party to make reps and warranties to each other. And the way the buyer will protect themselves that ensures that those reps become true, are proven to be true over the warranty period, again, typically 12 to 18 months, is by holding aside in an escrow account a portion of the agreed upon sale price to ensure that those reps, in fact, come true. As they come true, those dollars are released. Again, not every contract will have all three of these ingredients. We closed the transaction last week as an example. The buyer wanted an escrow agreement. We said no, because you want a promissory note and an earnout agreement, and we've agreed to those. We don't want the escrow agreement. Eliminate it, and we'll give you offset rights to the promissory note and or the earnout agreement. So we were able to eliminate the escrow agreement. That became additional cash available at close. So again, it's all negotiable, but from the buyer's perspective, I'm trying through this presentation give you how they think of things and how they're trying to essentially accommodate themselves from a risk perspective. And clearly what's going to happen from the cash perspective, they've got the seller's going to pay off their professionals that are on their team. Typically, some portion or all of the liabilities will be retained post-close by the seller. And so essentially these deals, the kind of the construct or the term of art is most deals are cash-free, debt-free. So they retain the cash, but they also retain and have to settle up the debt. And of course, unfortunately, Uncle Sam and Uncle DeWine are going to want their portion of the deal in the form of taxes. So that idea, how does the deal structure flow into the cash, and how is cash received by the buyer, excuse me, by the seller and paid by the buyer? Um, Another thing to consider, and this is the last slide, how long does all this take? The takeaway here is perspective, it takes a while. Depending on the size and complexity of the company, and hence the size and complexity of the follow-on transaction, the due diligence requirements, et cetera, we say it's going to take up to 9 months from time zero entering the marketplace to a close. We've done deals in as little as or as few as 4 months. Some have taken up to 2 years because of complexities and changes that occurred during to the company during the due diligence period, et cetera, et cetera. But the takeaway here is the buyer expects to see at close the company that excited them uh, as represented at time zero. At time zero performance is what goes into the marketing docs. That's what the buyer has seen. That's what they're working off of. That's typically what they will submit their letters of intent based on. They expect to see that months later at the end of the process. And if they don't, they're going to retrade the deal, they're going to reprice the deal, and or they're going to walk away from the deal. Again, that's what leads into Adam's comment earlier, only 30% close. So the seller has got to keep their pedal to the metal and keep working their company as if they're going to keep running it for the next 10 years and making all the decisions to keep it growing. Uh, Unless, or rather, if they don't, then what I just said will happen from the buyer's perspective. And Adam, that brings me to the last slide, just some contact information for me if anybody's interested in following up with any other questions or whatever. So, Adam, I'm turning it back to you.
All right. Well, you made that part easy for me. So we'll close out with contact information last in a second here. But first, I know we don't have much time, but I do have three questions here. Two of them are actually related, but I don't want to ask them right next to one another. So I'll make them separate. The first is, so Bob, what is the first thing a business owner should do if they're thinking about selling, but they have done nothing?
I would say engage the services of a professional that is in the business of counseling and helping to prepare business owners for an exit. I have great respect for folks like Adam that have they're certified exit planners that can help tee up a business, share a lot of the kind of things that I've talked through in my presentation. It helps them understand process, helps them identify gaps or weaknesses in their current company, how they're structured, et cetera. Um, Guys like Adam also know what buyers are looking for and are perfectly positioned to help business owners prepare.
Awesome. So somewhat related, and I know the answer to this question, but I want to hear what you have to say. This person says, how far in advance should I start planning my exit, and what steps should I take early on? So, like I said, you kind of answered the second part there
Yeah.
already, but there's probably a few different opinions in terms of how far in advance someone should start planning, depending on their goals.
Not to be flippant, but the real answer is from day one. If someone buys a company or starts a company, they should start planning their exit literally from day one. That will inform them how best to run the company, knowing that 5 years, 10 years, 20 years down the road, it's going to eventually be transferred, whether it's to a family, to employees, to a third party, like we kind of emphasize in this presentation. That would be the ideal. Most people don't do that. I know that. I get it. You saw the slide where most people don't do any planning at all. And then they're faced with a health issue, a crisis in partnership, divorce, whatever, and they're forced to start doing all that planning in real time at the last moment. The other side, stop being flippant from day one. 2 years in advance would be my perspective. 1 year in advance would be worst case. That would give the business owner time to rectify any problems with the company. Usually over 2 years, you can fix a lot of stuff. The closer you get to the 1 year or less, it becomes much more problematic. Think of the business owner. I cited an extreme example. It only had a couple of clients. A great business, had built a wonderful life around those couple of clients, but essentially does not have a business to sell. Certainly not at a valuation that would excite the business owner. Give them a couple of years, however, or her a couple of years to start to expand that customer base to a point where, from a rule of thumb perspective, you don't want to have any customer owning more than 10% of your revenues, or ideally 10% of your profits. If you can move from that two company, each with 50%, to 10 plus, so no one has more than 10%. Now you've had time to move in that direction. You have already greatly improved the value. So flipping, day worst case, 1 year.
All right. I love that and the first answer, by the way, because I don't think I've ever heard you say that, but that's what I'm so passionate about is getting people to start planning, even if it's not going to be, years from now, just because of all the benefits it creates within the business. First of all, right now, as they're growing, but then it's exponentially going to be worth more when the time does come to sell. But anyway, I know we're 1 minute past the hour, but we've got one more, so I want to go ahead and hit it. The last question is, what metrics, this is a good question. What metrics should I focus on when determining the value of my business? And how do I know if I have an accurate valuation or if I'm way off?
Good question. There are certainly valuation professionals in the marketplace. That is all they do. And they will have expertise by industry. They will have access to databases by industry. Again, I think I cited that algorithm earlier in the presentation where the rule of thumb of adjusted EBITDA multiple. That's the coin of the realm, if you will. There are other metrics, other valuation techniques that are done. That's the simple market-based valuation that we typically work with. Valuators, however, will also build out pro formas. They'll do discounted cash flows. Uh, they'll do capitalized earnings. There are about 3 or 4 different methods that they will use to create a comprehensive valuation model, and out of which will come a valuation that they would suggest is valid at that moment in time. And thereafter, if you really want to keep track, having a valuation done every year by a valuation expert would be a valuable exercise.
100% helps you almost benchmark things and make sure you're staying on track.
Yep,
It's good
absolutely.
stuff. All right, Bob. Like I said, we were a little bit over here, and I know I said I'd stop right at 1, but it's 1:03. So let's go ahead and wrap up. First and foremost, if you'd like to get a hold of Bob, you're looking at your screen here. His email's there, his phone is there. He even put his cell phone there. That's dangerous, but good for you. He's usually buzzing around town helping business owners, so I don't know that I'd just show up to his office, but email's probably the best way to get a hold of him. We're going to be doing a podcast later this month, recording it, and then it'll be published soon. So be on the lookout for that. More of a conversational, more of a conversational style of the same very topics we talked about today, but a little bit different style. And then next month on November 21st, we're going to be doing another webinar just like this one. We'll also have a recorded replay. The title is Profitable Goodbyes, a Masterclass in Exiting Your Business with Joe Sophia at First Financial Bank. And then we'll also have a podcast for that as well. So with that all being said, head over to elevateandexit.com to sign up for invitations to the future events that we have here so you don't miss out. Subscribe on YouTube to get these replays sent to your inbox in the future as soon as they're published. We'd truly appreciate it if you'd fill out the survey that'll be hitting your inbox in the next 24 hours or so, just to hear what you think. To see if you have any ideas or concepts for future events. And then, of course, follow Elevate on LinkedIn, Facebook, Instagram, and Twitter. And lastly, as I always say, owning a business is freedom. It's fulfilling, but it's unbelievably rewarding and not easy. So why do it alone? Elevate doesn't exist without all of us, without you. So thank you so much for coming. Thank you for attending, and we look forward to seeing you at our next event.